Colombia's central bank keeps interest rate at 12%. That single number resets the market's playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. Colombia's central bank just proved that theory wrong. Banco de la República held its policy rate at 12%, the highest in Latin America, after 13 consecutive rate hikes since 2021. But here's the problem: inflation is still sitting at 7.6%, double the bank's 3% target. They've hit a wall, and it's becoming clear that monetary policy alone cannot solve what's actually driving prices up. This is the moment emerging market central banks everywhere should be paying attention to. Because what's happening in Bogotá right now will reshape how every central bank in the global south thinks about fighting inflation over the next 18 months. Let's break down what's really going on. When inflation first spiked in 2021 and 2022, it was partly demand-driven, too much money chasing too few goods. Rate hikes make sense in that scenario. You cool demand, prices stabilize, crisis over. But Colombia's inflation didn't work that way. Yes, demand mattered. But the real culprits were supply shocks, currency weakness, the peso has collapsed against the dollar, and wage spirals. Workers demanding higher pay because their cost of living exploded, companies raising prices to cover those wages, and round it goes. Raising rates from 3% to 12% kills demand, sure. That's working. But it doesn't bring imported goods back to normal price. It doesn't fix broken supply chains. And it doesn't stop wage expectations from accelerating when people feel poorer every single day. Here's where this gets dangerous for the broader emerging market story. Colombia's central bank is now facing a trap that every EM central bank fears: if they raise rates any further, they risk tipping the economy into recession without actually solving inflation. The currency is weak, borrowing costs are crushing companies, unemployment is rising, and people are angry about prices anyway. One more aggressive hike could snap the economy. But they can't cut either, because inflation is still way above target. So what do? They freeze. And that freeze is a signal. It says, we've reached the limit of what monetary policy can do alone. The problem now is structural. It's in wage expectations, supply chains, and currency depreciation. Those don't get fixed by adjusting an interest rate. This matters enormously if you're holding emerging market assets or you're an investor watching EM central banks. Because this freeze is probably the first domino in a chain of similar decisions across Latin America and Asia. When Colombia pauses, Mexico watches. When Mexico moves, Brazil moves. And suddenly you've got a cohort of central banks that have stopped tightening, not because inflation is solved, but because further tightening would break their economies. What happens next is crucial. We're likely entering a period where EM central banks hold rates steady or even cut selectively in 2025, even though inflation is still elevated. That sounds chaotic, and it is. It creates currency volatility, it pressures EM bonds, and it means inflation will probably come down more slowly than anyone hoped. But the alternative is worse: recession plus inflation, stagflation, the nightmare scenario. For regular people in Colombia and across emerging markets, this freeze signals that rate hikes alone won't bring relief. Prices will probably stay elevated for longer. The real solution has to come from supply-side policies: fixing supply chains, managing currency, controlling wage spirals without crushing employment. That's harder, slower, and requires coordination across fiscal and monetary policy. But it's the only way out of this trap. The contrarian angle nobody's talking about: this rate freeze might actually be good news for emerging market growth. Yes, inflation stays sticky. But a central bank choosing to hold rather than break the economy is a choice for stability and continued investment. That's worth something. Companies can plan. Workers can expect continued employment. Growth doesn't die. So watch Colombia's next move. If they cut rates in early 2025, that's your signal that central banks are officially pivoting from fighting inflation to protecting growth. That reframe, from anti-inflation hawk to growth guardian, changes how every asset should be priced. And it tells you something crucial about where the real risks are shifting next. This is the moment to understand, central banks are not all powerful. They can't solve every problem with one tool. Colombia just showed that. The question now is whether investors and policymakers across emerging markets learn the lesson, or whether we're about to repeat this cycle somewhere else. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.